Let's think this through. Pretty much every month, there's typically a week that has a multitude of economic data released by some government agency. Then another government agency like the Federal Reserve, or even just the politicians, use this data to justify their actions. Of course, then the media acts like they're waiting on all this data with bated breath. Of course, then a lot of this data just simply gets revised for one reason or another. I'm sure collecting all the data is complex, and there's likely a trade-off between timeliness and accuracy of this information. But changes in the economy don't happen quickly. It can take a long time, typically measured in months, or more likely measured in years, for policy and actions to filter its way through our economy. But don't estimate government policies, though, because they do matter. Inflationary policies and out of control government spending will eventually result in inflation. Look no further than the past few years. There is some recent data in August of 2024 that indicate the economy could be decelerating as the Fed's tighter monetary policy of the past 2 years finally gains some traction. So why do the markets swing much faster than the economy or the earnings of all the great companies that make up the economy? Ask another way, why do stock prices rise and fall so much more than the actual economic health of the companies themselves? I believe the answer is it's our human psychology. It's our human emotions that simply sometimes swamp our ability to make rational decisions within the stock market. Of course, the goading by the media and the media playing upon our human emotions, they don't help matters much either. But no matter the economic challenges the world's great companies experience, these great companies will continue to innovate. Employees will still go to work with the intent of making a meaningful contribution, and management will continue to adjust their decision making, however needed, for the long-term pursuit of earnings. And sometimes when there are bad government policies, excessive taxes, or adverse economic condition, great companies can and will choose to temporarily postpone some activities in whatever way they deem necessary. In reality, the economy and the market fundamentals aren't near as volatile as stock prices, but people and their emotions are. Yes, it can be difficult keeping the short-term data from adversely influencing our long-term success through owning great companies. But even when stock market prices have gone down, and sometimes by a lot, there's never been a time in history that the broad stock market prices didn't recover and then go higher. Of course, that's no guarantee for the future. In fact, there are no facts about the future. But short-term stock market fluctuations isn't the problem anyway. The real problem in any economy is inflation. Even modest inflation of 2 or 3% is still a very real economic problem over a working career, and especially in a 20, if not 30-year retirement. At any level of future inflation, and remember, the Fed has stated their target inflation rate is 2%. Inflation just simply means in every year, everything we want to buy will cost more money year after year. Rising living costs is the problem. Rising dividends from owning great companies is the solution. If history is a guide, and if we focus on dividends instead of prices, it's a very rare occasion that dividends ever go down. Think about it. If you want common sense, follow me.